Imagine a UK tech consultancy expanding operations into the US, processing a routine £120,000 intercompany software license payment. Under current reforms, this data point is immediately ingested by HMRC's new algorithmic risk engine. A minor categorization error at this stage can autonomously trigger penalties and initiate a formal tax inquiry before a human inspector ever opens the file. Precision is the only defense in this automated reality. At ProTax Accountant, we help businesses navigate the shifting landscape of international tax compliance. For finance directors and CFOs of scaling firms, these automated protocols change the risk profile of every cross-border transaction. Central to this shift is the International Controlled Transaction Schedule, or ICTS, and the strict £1 million trigger that mandates its filing. HMRC's new compliance architecture treats an ERP data entry error as a primary risk indicator, with penalties that impact corporate profit margins as soon as the data is uploaded. Many finance professionals assume they have until January 1, 2027 to prepare for the first ICTS filing. This timeline encourages businesses to delay systemic ERP upgrades and postpone necessary reviews of their transfer pricing documentation. However, the Finance Act 2026 reforms alter domestic transfer pricing rules a full year before the ICTS reporting requirement begins. This creates the asymmetric data window, a 12-month period where your internal rules change, but your mandatory reporting is not yet live. We will break down the £1 million materiality trigger, the granular data required by HMRC's £6 million infrastructure, and the specific risks of this 2026 transition. Delaying your data architecture rebuild until 2027 ensures your 2026 transactions will be analyzed by HMRC algorithms without the necessary supporting records. Traditionally, medium-sized enterprises were sheltered by a broad transfer pricing exemption that limited their reporting obligations. The removal of this exemption will bring thousands of mid-market groups into the scope of the full transfer pricing regime. A buffer rule exists. An entity must exceed the small threshold for 2 consecutive accounting periods before it officially loses its exempt status. Once in scope, mandatory ICTS filing is triggered if cross-border related party transactions exceed £1 million. This threshold is an aggregated gross calculation. Crucially, income and expenses cannot be netted against each other to stay under the limit. The formula is direct. Income plus expenses must be less than or equal to £1 million. Netting is prohibited. For example, receiving £600,000 in foreign income while paying £500,000 in expenses creates a £1.1 million gross total, immediately triggering a full ICTS filing. Furthermore, a single transaction with a non-qualifying territory, one lacking a UK double tax treaty, entirely revokes this £1 million protection. The ICTS captures businesses based on the gross velocity of their cross-border cash flow, regardless of their final profit margins. HMRC has invested £6 million in technological infrastructure to build analytical engines capable of automated, data-led risk profiling. These systems require extreme granularity. You cannot group transactions under general labels like services if a single category exceeds the £100,000 de minimis threshold. A ledger entry for services must fracture into specific transfer pricing data points. Every category requires the counterparty jurisdiction and transfer pricing policy. The schedule also demands profit-level indicators and the exact markup percentages utilized. Most legacy ERP software tracks statutory accounts, but lacks the capability to generate this transaction-level margin data automatically. HMRC's algorithms will use this data to cross-reference your operating margins against industry benchmarks, instantly flagging statistical outliers for review. These benchmarks are derived from international standards. This building represents the origin of the global transfer pricing guidelines that HMRC's algorithms now enforce. The ICTS requires highly structured transfer pricing data that most accounting systems were never configured to produce. The chronological rollout creates a specific conflict. While the ICTS launches in 2027, the disapplication of UK to UK domestic transfer pricing rules occurs in 2026. Consider a UK entity that adjusts its domestic recharges in 2026, following a change in cross-border pricing from its foreign parent. Because domestic filing is not required in 2026, many businesses may neglect to document the commercial rationale for these internal shifts. When ICTS goes live in 2027, HMRC's system will map cross-border data against your undocumented 2026 domestic movements. This automated check flags the group for VAT anomalies or profit diversion based on those undocumented shifts. Maintaining contemporaneous records throughout 2026 is an absolute necessity, regardless of whether you have a formal filing requirement that year. The 2026 reporting gap is deceptive. Your internal documentation during this period is the only defense against the automated algorithms that activate in 2027. Failing to structure data correctly for the ICTS creates concrete financial liabilities. Careless or deliberate errors on the schedule fall under the general inaccuracy penalty regime, leading to tax-geared penalties between 30% and 100% of the shortfall. This is accompanied by a flat statutory record-keeping penalty of £3,000 per return if you fail to maintain the underlying granular ledgers. Compliance requires an immediate operational upgrade to your ERP system. Failure triggers automated, tax-geared penalties that subtract directly from corporate profits. Managing the ICTS requires a daily shift in how your business segments financial data, moving away from a reliance on year-end accounting adjustments. The filing deadline may be in 2027, but the data architecture required to survive it must be established today. This content is for educational purposes and does not constitute formal tax or legal advice. If your group is approaching the £1 million cross-border threshold, do not wait for automated systems to identify the gaps in your data. Contact Pro Tax Accountant at 07985 689 912 or email info@protaxaccountant.co.uk to future-proof your transfer pricing strategy. Subscribe to the PTA YouTube channel for ongoing technical insights into UK tax reform.